Welcome everyone to another edition of Boston Real Estate Town Hall.
What's up, guys?
Yeah, today we have live with us, a question and answer with Shant Banosian, and he's with Guaranteed Rate.
Thank you for having me. This is great.
Yeah, absolutely. And Shant is, I've known Shant for a number of years, and he's recognized nationally as one of the top lenders in the country, not even just Massachusetts. So it's a pleasure to have you on, Shant. And
really my pleasure. This is awesome. I appreciate the opportunity. Thank you.
Yeah. So, we've been talking over the past 4 or 5 weeks. This is our 5th episode.
Oh, cool.
Doing a COVID centered real estate market updates, and having lenders on, having interior designers on, and just trying to get, a general sense for people to, get an understanding of what's going on, what to expect, and, to be optimistic or to hold off a little bit. So I think you're going to be a great person to give some quality advice, whether it's a real estate agent on, or homeowner on, or buyer. So
yeah, absolutely. I had some notes that I just dropped as my kids came in and tried to mess with me before I went live here. I'm happy to talk. I think the industry has changed so much in the last 6 weeks. It's like I feel like it's changed more in the last 6 weeks than it has in the last 6 years. So it's been, there's good, there's bad. I mean, the good is that I'm actually pleasantly really surprised with how much activity is going on still. Considering the gravity of what's going on. It's we've got a global pandemic, everybody's locked inside, businesses are closed, but somehow real estate's still chugging along, right? People are still buying houses, people are selling houses. It just shows how much pent up demand there is, and fortunately, in my opinion, with us being in Boston with such a strong market, fortunately our market is not super reliant on tourism and travel. It's based on solid job sectors, and so there's still a lot of demand, still multiple offers, there's still stuff happening. It's crazy.
Yeah. So, and it's I think it's kind of specific to each neighborhood and town. But certainly it seems like overall a lot different than 2009, with the supply being not the same then, when we overbuilt, we had so much supply, and now it's every neighborhood's struggling for listings, and buyers are in multiple offer situations when it's virtual, which is a little different than I've ever seen. So I guess, what are you seeing in terms of your business right now? Are you doing more refinances or new purchases? Is there is the shift in percentage a little bit different now than it has been?
Yeah, definitely. So what's happened is that there's definitely more refinance business happening than there was in a typical spring market. What's happened is the government has purchased. The government is, as a part of the stimulus that happened, the government's buying mortgage-backed securities and trying to keep mortgage rates super low, to try to make sure that this health crisis that's turned into an economic crisis doesn't turn into a housing crisis. So I do think that everybody that is a homeowner out there should be looking at refinancing right now. It might not make sense for everybody, but it's worth, if you're stuck inside and you're looking for something to do, pick up the phone and call your lender, because there's some really good opportunity to save some money right now on your mortgage. We're seeing historically low rates, especially with conventional loan amounts under $690,000. Those rates are really excellent right now. People are saving $200, $300, $400 a month. There's ways that you can eliminate PMI. There's people that are taking cash out to do some debt consolidation or home improvements. Or just honestly, help pay their bills during a challenging time. So your home is a valuable asset that you can use for many different things. Right. We're definitely seeing some purchase market too, though. It's the purchase business is down, but it's not down from down to 25% of what we were doing at this time last year. Our business is down about, on the purchase side, about 30% from year over year. Okay. But still pretty strong. It's just there is less stuff on the market, but fortunately we work in Boston and the surrounding suburbs, and the demand is still relatively I've noticed specifically in the last 2 weeks, the activity's picked up dramatically versus the first few weeks. I think people are kind of getting bored of being inside and trying to figure out what the new normal is and just adapting to it.
Yeah, and I think New England, we have the benefit, even though it's not like a weather benefited area, but when weather does come out, we've been waiting for so long, like great
Yeah,
weather, that it definitely affects the real estate market. And I think the month of May, historically for me, Mother's Day has always been like, pretty much like the highest point of the year, right around this
yeah,
time. And so I think that that's going to really help us, get more showings, get people optimistic. There's something to be said about like that vitamin D and sunshine helping
100%.
out with it too.
I agree with that.
So, a lot of my buyers are also asking, should I wait? Are the rates going to go any lower? Can you speak to like historically, is there like a floor to mortgage rates? I know, some people are like, oh, the Fed just dropped their interest rates. And, I know the banks are not 100% following, that specifically. So can you speak to, some either metrics that you're following or where you think it's going, or, is now the time to do it, or is it going to be the same for the next 4 or 5 months?
Yeah, absolutely. So I would say that the Fed, when you see in the news like the Fed cut rates to zero, that's bank to bank lending overnight, for 24 hours, right? It's not a 30-year fixed rate mortgage. However, at this point, we're I would say confidently that we're at the lowest rates ever, for the most extended period of time, anyways.
Mhm.
Right now on a 30-year fixed, you're in the super low threes, or even at 3%. We're at in all the 10 and 15-year stuffs in the twos. So those are like amazing rates. Are they going to go lower? Potentially, but they could also potentially go a little bit higher too. I don't think there's like a floor that's set, like an official floor anyways, but I think we're getting pretty close to it. Like, I think sometimes we forget that, like, obviously this was unplanned, right? Like, the economy was really good 2 months ago. Unemployment was super low. Stock market was at all-time highs, all those things. 10 years ago, I mean, the whole financial market like literally melted down,
Right.
and the stimulus was thrown at it and all that kind of stuff. And they knew it was going to take a while, and rates really never dipped below the levels that we're at right now. So is there potential for them to go lower? I suppose. I mean, I don't think anybody's ever really like planned for a global pandemic where like this happens to the whole world at the same time. Usually when our economy has been impacted, it's, obviously we're in a world economy right now, but I don't see them going much lower.
Right.
I'm pretty confident that we're in the range anyways of where they're going to be.
Yeah, I kind of think the same thing. I actually think, the demand for, from what from lenders I've spoke to, the amount of demand in February and March has like, I went through 2 refis, and they were backlogged so much that it was a 50, 60-day closing process. And I was like, whoa, this is insane. I'm like, we had an appraisal done like 40 days ago. So
Yeah,
what's going on?
yeah,
But yeah, no, it seems like, now they're artificially like, through the applications a little bit higher.
yeah, yeah. So I mean, it's supply and demand, right? Like you got all these lenders and their staffs working from home. You've got, which is like, takes slows everything down a little bit due to technology and accessibility and all that kind of stuff.
Mhm.
So typically, what happens when lenders can't take on any more business, the easiest thing to do is raise rates, and that slows it down a little bit, right? So I think we're going to be hovering. I think we're pretty much the level that we're at right now. We're going to hover around. And then obviously if, you just never know. I mean, we're in unprecedented times. So certainly,
Right.
in a lot of ways, personally, from being a loan officer, I mean, the lower the better, right? Like, I want to refinance everybody and help my homeowners get the lowest rates possible and lowest borrowing costs. However, sitting back and look at things economically, I mean, if they dip into the twos, that means we got massive problems, right?
Sure.
Like, across our economy. So I don't know if that's a good thing.
So, looks like Myra asks through this chat, what's the biggest difficulty to people getting their mortgage at this time?
Yeah.
Yeah.
Good question. So, the biggest thing on lenders' minds right now is that, the amount of job loss and income reduction that's happening across the country is astonishing, right? So, just 2 months ago, we were at 3% unemployment. I think we're going to be at 25% unemployment when this thing's all said and done, somewhere around there, right? That's a huge change just in about 60 days. So lenders are terrified of unemployment, loss of income, and then which results in potential job loss, right? And what lenders are doing is they're cutting back on risk. So things that are happening is that from a challenge from a home buyer is that if you were pre-approved 2 or 3 months ago, that pre-approval may no longer be valid anymore because the guidelines are changing so rapidly. So
Yep.
I think the biggest challenge as a potential home buyer right now is just staying current with your qualifications and your guidelines. In the last 6 weeks, FICO score requirements have increased. Loan to value requirements have gotten, lower down payment options are starting to disappear in certain loan segments.
Okay. What about debt to income or
debt to income ratio? More reserves are required. So just products are changing fast, and the way, and then so just keeping up with that is probably the biggest challenge. I have things were really, really good for the last 5-6 years. The housing market recovered. The economy was doing roaring. So what happens when that happens is things get loose. Like lenders want to do more because things are good, and it's a safe investment. But when things tighten up, they cut back immediately. And from a lender's perspective, not me individually as a loan officer, but like from a financial institution, a bank, a mortgage company, what they're doing is logical, right? Like ultimately, at the end of the day, they want to stay in business. They want their employees to be employed, and they want their shareholders and stockholders and stuff to do well. And then on top of that, they don't want the entire mortgage market to collapse. So the way you can protect it is by, getting more conservative with your lending. And obviously that works. Look what happened in 2008. Because underwriting got really, really conservative, housing market soared right back up because mortgage default went low. Everything got straightened out from a compliance standpoint, regulatory standpoint, and U.S. housing markets on a roar.
Yeah. And, in regards to, I think especially locally in Boston and surrounding towns, jumbos are a huge part of it. And I know that that's been a big issue for, some lenders. And I don't know if you could speak to like, in terms of, is it harder to get like larger banks or community banks, or, who are you getting to do these jumbo loans? Is certain investors buying these products or not buying them right now? Is there there's definitely, obviously it's all about risk, I'm sure, but that changed at all?
Yeah. So that's probably been the biggest change in the market since it started. What happens with a jumbo loan is that loan is not insured by the government. So when you hear Fannie Mae, Freddie Mac, FHA, VA, Mass Housing, all those acronyms, those loans, the banks are protected when they lend to those guidelines and those loan amounts, because if that loan goes bad, that Fannie or Freddie or FHA is a loan insurer, so they protect the bank in the case of default or risk. So, portfolio lenders or jumbo loans don't have that kind of insurance. So if that loan goes bad, it's based on their deposits and their financials, right? So they have to eat that. And so we've seen a couple things. So because of that risk, we've seen either some people restrict their guidelines or get out of the business altogether. Like, on our end, a couple of big banks like Wells Fargo stopped taking loans. We've had a couple other, big lenders that have stopped buying loans from mortgage companies like us, and or restrict their guidelines drastically. So what that does is, one, the other people start looking around like, well, if those guys got out or those guys restricted this, maybe we should do the same. And two, it puts pressure on the people that are left because they get all the capacity, and they tend to slow down a little bit too. So, and then what happened again, when they start to get kind of filled up, what they have to do is they have to figure out what kind of loans they want. They can get a lot more picky, and they tighten things up and they start taking only pristine loans. So what we've seen happen in the jumbo business is, the first thing I've noticed happen is the lower down payment stuff's disappeared, right? Like it's really hard to get a jumbo loan with 5 or 10% down, or even percent down, where just 6 weeks ago it was super easy. We've also seen a lot of the home equity line of credit lenders stop doing like piggyback loans and whatnot.
So 10-10, what do they call it? The 10-10,
80-10-10, or piggyback, whatever you want to call it. But those people have gotten out too. So it's definitely gotten a little bit tighter. But if you've got 20% down on a jumbo loan, like, you're still in good business. And a jumbo loan is defined by something over $690,000 borrowing power. So, it's not gone. It's just more conservative and vanilla than it was a couple months ago.
Right. So in terms of like the metrics, in regards to the health of the market in general, not just, where rates are going or, anything to do with what investors are buying, are there certain indexes, or do you feel like, personally, are you following certain trends? The Dow Jones, S&P, I know they had their best month in the last 30 years last month, but,
it's crazy, right? Correct. The month before was the worst ever.
Yeah. And, in 2009, I think there was like 3 of these, runs, of 20% or so during that bear market. So it's I think it's, certainly just an overcorrection and it's still going to be very volatile, but is there like loan applications or new construction permits or, something along those lines? Is there some, something that would indicate, some positivity and some optimism for the market to kind of flatten out and have some more, stability to it?
Absolutely. So to me, the number one indicator is going to be unemployment starting to get back down. You can take stock market, mortgage applications, all those things. At the end of the day, once people get back to work, things are going to be okay. Until then, that's going to, if anybody's looking to watch something to the health of the market, whether it's housing market, mortgage market, stock market, whatever, they should just track unemployment. So the minute it starts to improve, then you're going to see everything improve. Sorry, you got a straggler in the background.
Oh, do you? You do. Yeah, yeah.
I do. Yeah.
Yeah. Yeah, if she wants to speak to that too, she can. I know I've seen her on. I've seen her on some of your episodes, explaining some of the stuff. I was impressed.
The cool part is that with all this work from home stuff, like a couple of weeks ago or 6 to 8 weeks ago, if they'd see me on the screen and talking to somebody, they'd be like, "I'm out." Like they'd know to be quiet. Now it's become so normal that like, see, here she is, like doesn't care. It's just so normal. I'll help you on this. Use that one. Okay, sorry.
No worries.
It's all good.
So in regard, and the other thing too is, we're now becoming homeschool teachers and having a second job. So this is really interesting to test how much focus you have. Yeah. So another thing that's come up is the topic of forbearance, and I know that's it's not a new thing, but how has it changed with the CARES Act, with forbearance and, their initiatives with the CARES Act and how it used to be? Can you just add it to the end? I've heard that's an option with some banks, but, I know it's under the lender specific.
It's different, that it's different per bank. Some people want it paid back in a lump sum. Other people want it added to the back. It's one of the biggest concerns from a lending perspective. So put yourself in a bank's shoes, right? If you write a loan, and all of a sudden now you've essentially, it's come down like as from the government that you can, go into forbearance, whether it's 6 months or 12 months or whatever, whatever the wording was on that. It's like, do you really want to write a loan, brand new loan, like the new loans that happen right now, and then all of a sudden not get paid for the first year potentially after you write that loan, right? Yeah, so it's like, it makes, that's actually put a lot of pressure on interest rates. It's put a lot of pressure on guidelines. That's one of actually the main reasons that that guidelines have changed so much, because of like the drastic amount of forbearance that's actually happening. I think I read something this week that like 10% of borrowers were in forbearance already right now. That's a huge number.
Oh my God.
Yeah.
That's that. And that's the same thing kind of with, we were talking last week about commercial, or 2 weeks ago about commercial space in the commercial real estate market. I think, from the real estate market perspective, that's going to be hit the most in terms of retail shops not paying their rent, especially, and not really having an option without any income. So along the same lines there, not really.
I mean, I think if you're a consumer, if you're a consumer looking at forbearance, I mean, my suggestion would be just call your mortgage servicer directly, whoever you're making the payments to, and just ask them what their options are. And before you agree to it, just please make sure that you understand what the repayment terms are, how it impacts your credit, so on and so forth. Because there's it's so new and there's some misinformation out there. This is all I do every single day, and it's even a little bit unclear to me because there's so many different lenders and servicers out there and their interpretation of it. So if somebody's watching this that is a client that is considering forbearance, if you call these mortgage companies, their service departments will tell you very specifically what your options are. They'll make it clear to you. Make sure you read everything in writing before you agree to it, just because you want to make sure you're clear on what you're getting into.
Yeah, and you don't want to get into a situation where you can't refinance, or I heard that if you're in forbearance, that's one of the restrictions. Or any pitfalls with potentially being liquid to sell your property, if there's any concerns there. But I wouldn't just jump right in it, or just stop making payments without calling your bank either. That's I've heard some people are, I'm just going to stop making payments if I lose my job after just buying a place. So I hope they're calling.
You got to just understand it's a big deal. Your mortgage payment is it's on your credit report. You just got to make sure that it's you understand what you're doing and with the ramifications that come with it. If it's, I understand if it's need based, it's totally that there's a reason for it and it's a great option, and I'm thankful that they've made it clear. I just think that there's a lot of news being put out there without details. So a lot of times, you can't, for example, you can't just stop sending in your payments. Like the mortgage company doesn't recognize that as being in forbearance. Like you actually have to enroll in the program and
Yeah.
communicate with them in advance,
In regards to like, this is a question I just thought of actually. A lot of my clients are either half commission, fully commission, or self-employed. And is there any like, not so much discriminate, is there anything going against W-2 versus self-employed, or are the banks kind of holding off on just certain people in certain careers? Or, I know that I had one of my clients had to fight with a community investor bank because she was in the travel industry, and the community banks like we're not lending to anyone in the travel industry. And I didn't know if that was like predatory, or not predatory, but discriminating, against an entire industry, even though she was, gainfully employed with a W-2. So
yeah.
is that allowed? Or yeah.
Yeah, I mean, what we're doing is what we're seeing is that if you're a W-2 employee, we're not kind of really picking on one industry or another. We're treating everybody the same. If you're a W-2 employee, we're just looking to get your most recent pay stub prior to closing, and just having it show that you're still getting your regular pay on a regular basis, so you paid up until closing. If you're a self-employed borrower, we're asking for your most recent bank statements from your business accounts showing that revenue is still coming in. We want to see that, you're still getting, collecting on invoices, generating revenue, so that, but if your business is shut down and revenue stop coming in, that's going to be a problem, as you have add-on expenses like a mortgage. So we're treating all self-employed borrowers the same. We're treating all employed borrowers the same. We're just looking to prove that, there's not been a massive change in their income over the last 6 weeks, which is really hard, because like it happened so fast. But it's, we're just looking to make sure the information that we started with is the information we're finishing with right before closing.
Yeah, we've been doing vetting of, pre-approval letters even before setting up showings for certain properties, just because whether it's, overqualifying or just wanting to make sure that they're that far along and not wasting time with a showing. It's been kind of nice to get very serious buyers in the listings I have and my team has. But at the same time, it's always nice to be able to, showcase a property and have someone walk through that might not normally be interested, and then pulls the trigger because they saw it in person. So there's definitely a balancing act there. But I know that most of the real estate agents out there are overqualifying with some sort of vetting of the lender, and then under agreement, even before going under agreement, making sure that like that person still has their job, or because most banks and clients after the pre-approval aren't talking for a while. And yeah. So is that something you're doing, just checking in with your client?
And one tip, I mean, I think that's great that you guys are doing that, because like what things that lenders should be doing is making sure that anytime a client's going to submit an offer, is that we always ask our clients to reach out to us prior to making an offer. So what that does is that allows us to give them real-time information on interest rates, on product guidelines, property specifics. I try to customize my pre-approval specific to an offer. I find that presents better, and it also gives me a time to check in with my client. Not only has our stuff changed, but has their stuff changed? Like and how do those kind of intertwine? If I'm a listing agent on a property, I would 100% want an updated pre-approval and confirmation from the lender that the pre-approval that was issued a month or two ago is still valid today based on all the recent changes. Now, I've done a bunch of these calls with real estate teams, and I've said a bunch of times, 2 months ago might as well have been 2 years ago and had a pre-approval at this point.
Right.
Like, it's just so much has gone on. So, and then, if you're a buyer, you want to really make sure your mortgage contingency date protects you, right? Because like, if you get a contingency, say I issue a commitment letter today, right?
Yep.
And I say, hey, congratulations, your loan's done. You're approved. We have nothing left we need from you. We just got to wait till closing. And your closing's not till next week, and you lose your job today. You're not guaranteed a loan. In fact, you're going to probably likely be denied. So the last thing you want to have is somebody lose their job, lose the house, and lose their deposit, right? So I think it's really, really important that we protect our buyers with further out contingencies, because you just never know. You never know. There's no way for me to verify whether a client's going to keep their job or lose their job prior to closing. I can't call their HR department and ask them if there's going to be a layoff. I can't call their CEO. I don't know the inner workings of their companies or their financials. I'm just going based on, are you employed now or not? Like, I can't, people ask me all the time, like, you said you had a client that was in the travel agency, right? A travel business. And that makes sense. Like, all right, travel's been impacted, so that industry has been impacted. Well, I had a physician lose their job last week, and you think medical professionals are safe right now. Well,
Right.
that physician, he was doing cosmetic surgeries. Well, guess what's not happening in hospitals right now?
Yeah.
Cosmetic surgeries, right? Like a dentist right now, not a lot of dentists are having appointments right now, right? Most of them aren't. So like, everybody has, paradigms on, who's good and who's not. And the reality is that none of us can predict it. So we just got to be overly protective of our clients.
Yeah, and 2 points of that. One is I have a cavity right now, and like I can't drink anything,
Yeah.
and I don't know when that's gonna. I'm just dealing with the pain. Um, and then, I forgot the second. Oh, no, the second point is it would be interesting if you're doing this job verification, then you're the one delivering the news that they are doing
Yeah.
layoffs, and you're canned. So I thought that was kind of.
Yeah. It's been unfortunate. I mean, it's been heartbreaking. Some people, unfortunately, like I said, there's been a massive job loss. So, and a lot of people don't see it coming. And especially to have it kind of happen when you're dealing with like a really cool moment in time in terms of like buying a house, it's generally a really positive experience, even
Yeah,
though it obviously can be stressful. It's like, it's a major life goal for most people, right? Like buying that first house or whatever, whether it's the first
the
one.
American dream.
Yeah. And so to be dealing with all this stuff at the same time is obviously stressful. And we like the wins and the positive stories, but right now there isn't some as well. So we're just doing everything we can to inform our clients, do everything we can to protect them, and make sure they hopefully get to a successful finish. And if things that happen outside of their control pop up, that they're not in a position where they're gonna lose their deposit or something.
Right. Oh, we got a couple more minutes left, but
Cool. Yeah.
So I got a question here from Lisa. If someone gets a pay cut, does this affect their pre-approval or their commitment after the fact? I'm sure that it's all dependent on what that pay cut is and that
Yeah.
right? Yeah.
100%. Yeah. We consider whatever the pay cut is. We'll reevaluate their debt to income ratio based on what their income is. We have to use whatever that pay cut, that new income is. As long as they still qualify, then we're good. If they don't qualify anymore, then it could impact things.
Yeah. Okay. Yeah, but it is an option, even into the process to get a cosigner on some of these. So I know that's
We've had that happen. Yeah, we've had parents jump in, brothers, sisters. Weird stuff has happened. So we're being as resourceful and crafty as we can be.
Yeah, and so one more question here, and then I have one more point. But how are appraisals being done from?
That's been a massive shift, and it's actually been a really positive one. So appraisals are mostly on purchases, mostly being done via desktop. So appraisals aren't even, not only are they not driving by the property, they're just literally collecting the information. So most of our audience on here is real estate agents or a little bit of both, or what do we got? Mostly agents?
Real estate agents, clients, people in my big massive mail that I send out to people.
So what's important is to keep in mind that, so the cool part is technology allows the appraiser to gather data without actually having to go in the house, right? But that's relatively new. The challenging part is that they don't go into the house, right? So they don't know what's great about it. Mistakes can happen because they don't see things or know about improvements or updates. So it's really, really important. If I was a listing agent, one, I would make my listings that much better. So I'd have, the pictures better, the descriptions better, everything, just be more detailed and try to be super accurate. The other thing I would do, is I'd have a walkthrough video and I'd be sending that to the appraisers. So the appraisers can effectively walk through that property as if they were there and see all the updates and additions and renovations. I think that's really, really important because it does lead to, some potential error or miscommunication if they actually don't go into the property and clarify some things.
Yeah, especially like age of systems, all of that in the description, I think is important, or having some information sheet in regards to upgrades and renovations that are done. And then, just lastly, this came out from the NAR that they project a 13.5% drop in home sales compared to a 3% increase, which they predicted at the beginning of the year. Is that kind of in line with what you think? That makes sense with, 13% being almost like, 1 month or month and a half, but yeah.
I mean, I think that's in line. I mean, look, there's, like I said, there's still activity happening. We're fortunate though. I mean, Boston has been a lot less impacted than a lot of places. Like, if you go to a place like Vegas, their real estate market's been devastated. I mean, it's their whole industry, their whole market is based on tourism and travel, right? So those places are going to be a lot worse than 13%, right? Whereas here we might be maybe a little bit better than that. The problem is nobody knows when this is going to get better, right? Like nobody knows when we go back to normal.
Right. Yeah, no, and I always advise people, anytime you're looking at like national rates, national trends, that just goes out the window in Boston because it's a very wealthy city, and there's not any like new land to be built on. So it's
small,
just a different animal. But yeah, so if you have anything else, Shant, I'd love to hear it. But if not, it was great to have you on. And
yeah, I would say, right now is a time, I think just, my advice would be just be more prepared than ever, like really understand your budget, really understand the inner workings of what you need to do to get, I would say, it's a little bit harder to get a loan than it was 6 weeks ago. So you want to make yourself as a buyer or as a borrower as attractive to the banks as possible. So anything you can do to really kind of get your credit up, button up your income and your assets, your down payment, like really understand your budget from a monthly payment, down payment, closing costs, like really just be prepared. I think that is going to be a key factor right now, and in terms of like having success in a housing market like this.
Great. Well, that's all good info. Thanks for coming on. Let's see here. One person just mentioned something. Oh, super helpful. Thanks.
Oh, cool.
You're welcome. Yeah, hopefully we can do this again.
This is awesome. Thanks for having me.
Yeah. And go hang out with your kids. They're ready for you.
Yeah, they did much better than I thought. I was pretty sure I was going to have to stop at one point and be like, everybody relax.
Yeah. Mine are in the closet right now, so I'm gonna
you can let them out. All right, cool.
All right.
Thanks, guys.
Yeah.
Take care.